Nowadays, there are a large number of unit trusts in the market. And during this discussion, I'd like to take us through what are unit trusts, understanding the diversification benefits of them, and also the risks involved while investing in unit trusts. My name is Charles Miano. I am the Senior Associate at Nabo Capital. And just taking you through to understand, one, what unit trusts are, and also diversification. I'd like just to speak just a bit on why diversification is important and where it's come from. As we know, diversification is a key tenet or element when it comes to investments. Why diversification is very important, it comes from the fact that there is risk. And we've heard so many times about what risk. We hear it in different conversations, but when it comes to investment, specifically risk is defined to an extent as the probability of your investment return not being actual or not coming as expected. In other words, you invest and then your outcome or the returns you expect to have are either lower than you expect for the most part, or you even can lose your initial investment. So those are the risks that are involved, particularly when it comes to defining that. And so when it comes to diversification, it means that you move your investments around to allow you to reduce that risk, to mitigate that risk. And I'll take you through the various steps towards doing that. So all in all, specifically in this particular discussion, we'll be talking about reducing the risk through diversification for unit trusts. And I'd like to take you through 7 steps in which you can diversify your portfolio of investments through unit trusts and ensure that you generate sufficient returns as you desire as an investment or as an investor. So the first step I'd like to take us through is just defining what unit trusts are, or to help you understand what is a unit trust. So a unit trust is a collective investment scheme. So this collective investment scheme is invested through pooling of different funds from different people, different institutions, and bringing it all together. And that is invested by an investment manager, typically a professional investment institution such as Nabo Capital. And then the pool of funds are then invested in different assets, including bonds, including equities, including cash and equivalents like bank and deposits, while others can be invested in property and other financial type of investments. So the benefit of unit trust is the fact that, one, you find that diversification through a professional manager investing your funds in different assets. Second is you become more of a passive because you delegate that investment action to someone who does this on a day-to-day basis. So you allow someone who's more professional in regard to understanding the investments, who looks at these investments on a day-to-day basis, to take that on your behalf. And 3, it aligns to what your individual goal or what your return requirement is, or various needs you might have as an investor. So that's the benefit of investing in unit trusts. And there are so many types of unit trusts, including money market funds, which look at short-term investment, fixed income funds, which look at long-term investment, equity funds, which look at investing in stocks, and balance, which mixes of both stocks as well as bonds, as well as cash instruments within those investments. And when it comes to sort of second step is determining your investment goal. So the most important thing that an investor can do is understanding, why are they investing? That's the first question you should always ask yourself. What is the purpose? What am I trying to achieve? What is my end goal? Be it short term, medium term, or long term. And it's very important because it defines particularly what type of investments you're looking at. It defines how much money you put in the various investments, and also it helps you avoid unnecessary efforts or wasting your effort or your time in determining what is right for you. So I'd say the first thing is determining your goal. Your goal could vary quite a lot. It could be to generate income on a monthly basis from your investment. It could be for capital growth, looking to invest for a long-term horizon. It could be just for the short term, maybe investing just for a month so you can utilize our funds for a different expenditure, be it like traveling or paying school fees for your children. So it varies quite a lot, but the first and most important question to always ask as an investor when looking for an opportunity is, what is my investment goal? And the third step is assessing your risk tolerance. So what is risk tolerance? At the beginning of the video, I mentioned what risk is, and it's important to understand what type of risk taker are you. Are you a high risk taker, meaning that you are willing to accommodate higher returns, but also you are willing or can be able to take up the risk, a higher risk? For instance, equities investments, which are investing in stocks, those typically have been known as high risk, high return investments. You can generate a very high return, but there is also risk that you could lose your money. You could invest, say, 100,000 shillings and make 200,000 shillings in investment return, an extra 100,000 on top of your initial investment, but at the same time you could lose that 100,000 or lose maybe half of that amount. So understanding what type of investor you are is very important. Then you could be someone who has a very low risk tolerance, meaning that you're not too comfortable with risk, and that means your preference could be, let's say, a money market fund, where it's the lowest type of return investment, where you earn a steady return, consistent return with very little volatility. So very important for you, after you've understood what your goal is, second is to understand what type of risk taker you are, and being honest with yourself, because this will set you en route to sort of getting the type of investment return you'd want, and also not getting disappointed in the future when things don't pan out, because at the very beginning you'll have set out for yourself that this is the type of goal that I want to achieve, and second, this is the type of investor I am from a risk perspective. And the fourth step is to understand the asset allocation. So when it comes to investments, there are various assets you can look at. I've mentioned some at the beginning, but I'll take you through step by step on each and every one of those assets. One of the key assets, major asset classes, is equities. So this is investing in stocks. Stocks are basically ownership in a company. So most of the investments within stocks are within the public markets. So public markets are markets where companies list. So these companies are listed in this market, which allow the public to participate by buying and selling of this stock. So when you buy this stock, there is anticipation of two types of returns: either capital growth, anticipating that, for instance, you buy a share at 10 shillings, it'll appreciate and go to 20 shillings, making you of 100%, or at least 100%. Or it could also be for dividends, meaning that you're receiving income based on payment from this particular payment from a company. Most companies typically pay either on a semi-annual to annual basis, depending on the profits that they make. So those are the type of sort of benefits you can receive from owning stock. However, as I mentioned before, it's very high risk, high return. Depending on the performance of the company, a company could do poorly and then the stock goes lower than you invested, meaning that you lose your principal, or the company could not, due to poor performance, will not be able to pay dividends. So these are type of risks that you take when you invest in equities, and are typically for high risk takers. And second one is fixed income or bonds. So these are investments that tend to pay a regular income. They're typically issued by the government. So governments issue treasury bills, which are short-term, less than 12 months. Then they also issue treasury bonds, which are 1 year and above. So these are typically viewed as low risk, and they offer that consistent income. For instance, if you invest in let's say a 3-year bond, currently in Kenya, a 3-year bond is providing a return of almost 17%. So that means you're receiving 17% on a annual basis, paid out every semi-annually or every 2 times a year. And then the second thing that you can look at from a fixed income perspective is either commercial paper or corporate bonds. These are issued by companies. We have certain companies within our Nairobi Securities Exchange that are listed. that provide corporate bonds, but also privately offered commercial papers. These are typically less than 1 year, which are offered by companies where they give you a fixed return, say let's say 15%, and they pay you every year for them to for you to lend them your money, and then they give you that type of return. So there is very low volatility, typically lower risk when it comes to government, maybe a slightly higher risk when you're investing in companies through the commercial paper or corporate bond, but nevertheless viewed as lower risk compared to equities. And the third is money market instruments. So these are investment in like a money market fund, where they invested typically in very low risk investments such as treasury bills, bank deposits. So these are viewed as investments for very low risk investors, and they typically are short term, very short term, typically even less than 3 months for someone who's looking to park their funds. So if you, let's say, know that you need your funds, we are nearing December right now, and probably you have a Christmas period in which you're looking to take your family for a holiday, but between now and December you're looking to at least park your funds, earn some interest on your salary or some investments, then a money market fund will be ideal. Very low risk, typically relatively high return, most of the time higher than bank deposits, and you have the flexibility of moving your money in and out quite frequently. So a money market fund will fit that bill. And then now other investments that are beyond other asset classes beyond the three that I mentioned: equities, fixed income, and money market instruments. You also have property. So property provides two benefits. One is the benefit of regular income through rental income, and second is the benefit of capital appreciation. For this one, capital growth, as we know, land always appreciates in value over time, and so investing in property can benefit you in the long term, but also it's viewed relative to how long you'd want relative to these other asset classes. And the last one will be commodities. So the more common commodity that most investors are aware of is gold. So this is viewed as a hedge against inflation, because when there's high inflation, as the environment we've been in, I'd say over the last 2 years, then investors are comfortable investing their money away from cash and then moving it to commodities such as gold, which tend to be very stable. So that's an alternative that investors can look at to diversify their entire portfolio overall. So moving into the fifth step is selecting your unit trusts, and it's very important to take into consideration certain features of unit trusts when you're evaluating them. We have so many within our investment landscape. When you look at your newspaper, you see a large number of unit trusts that are offered. So you ask yourself the question, which one is best for me? Which one should I choose? Should I choose the one with the highest return? Should I choose the one that is more known? So those questions can run through your mind quite a lot, and like to help to some extent help you sort of phrase what type of questions you should ask yourself when you've already won. As I mentioned, you already now know what your goal is. Second, you already know your risk tolerance. Third, you already sort of know which type of asset classes you'd be comfortable in. So one of the things to understand is understanding sort of the consistency of returns. So it's good to, when you're looking at the unit trust, to see, have they been consistent in the returns they've been publishing? So you want to invest somewhere there is consistency. Consistency does not obviously show what the future will hold, but it does give some level of credibility. So important to invest in somewhere where there's been shown that there is consistency of return.
That's what we do here at Nabo. I encourage you to go back. We have a wealth of videos that have been done before. Share this video with someone who needs it. And also remember to leave us a comment. And if you have any questions, just leave it behind and we'll tackle it in the next video. Thank you and God bless you.